Welcome to our Hedera quarterly webinar with Gregg Bell, Chief Business Officer at the Hedera Foundation. Today's discussion centers on why DeFi infrastructure must work for everyone. Many users today are excluded from DeFi due to unpredictable gas fees, failed transactions, and front-running. Hedera's unique design aims to make decentralized finance equally viable for retail and institutional users alike. We'll explore how prioritizing fairness and accessibility restores DeFi's original promise of democratizing finance. And as a reminder, the information contained in this webinar is for informational purposes only and not intended as investment advice. So with that said, welcome, Gregg. Could you please briefly introduce yourself and your role at the Hedera Foundation?
Yeah, nice to be here. Thank you for having me. We've really had a tremendous acceleration of engagement of late. So there's a lot to discuss here, so really excited to be here. I lead the financial markets vertical for the Hedera Foundation. We sit bridging traditional markets and Web3, very much focused on the needs of both institutions and individual investors alike. And I often say that Hedera has the proven power to scale to meet the requirements of a Fortune 500 company all the way to an individual. And that really is the strength of a network that is run and operated by global corporate giants like IBM, Dell, Google, LG, Hitachi, Aero Electronics, Deutsche Telekom, Nomura, Shinhan Bank, Standard Bank, and more. It's enterprise level uptime, performance, and scalability.
Awesome. Yeah, thanks for that introduction. Definitely a growing crypto market on all sides. So let's dive right into it. So first off, where do you think we are today in the broader DeFi adoption cycle? Are we still in experimental phases, or are we starting to see signs of real product market fit and relevant use cases?
So for individual investors and institutions, I believe that the multiple major exchange listings for HBAR, such as Robinhood and Kraken, these are really signals that we're moving from that experimental phase to mainstream adoption. Institutional grade platforms that are choosing HBAR, this really validates the enterprise readiness for the DeFi infrastructure that we have. It creates greater accessibility for investors. It's also really important for market structure and liquidity, right? If you look at the past quarter, we've seen numerous multi-billion-dollar days for HBAR trading in terms of volume, and that puts HBAR within the top 5 assets or liquidity buckets on several major exchanges. So, what I'm really excited about is seeing more listings, more custodial support for our ecosystem projects, projects like Karate Compass, Saucer Swap, Bonzo Finance, Hashpack, Kabila, and many more. But it's not just sort of the institutional side. Looking at the NFT side, so Dead Pixel Ghost Club on Centex.io shows how NFTs can really onboard users into Hedera's broader economy. Dead Pixel Ghost Club recently out-traded Pudgy Penguins and Punks for multiple days, exceeding all Solana and base NFT volumes. So to me, the key driver really is innovation. It's on-chain royalty payments for their Forever Mint structure. And this is in addition to collections like Twigital and HBarbarian that are really gaining more traction in part because they've leaned into AI 3D renderings, creating just this really thriving NFT ecosystem that ultimately funnels users into Hedera's wider DeFi economy.
Definitely seeing a lot of sustained growth within the Hedera DeFi economy. So on that note, in your opinion, what are the biggest barriers to mainstream DeFi adoption today, especially for those smaller retail users as opposed to institutions?
All right, so for individual investors, growing the stablecoin ecosystem is really key as it increases the ease of access and that access to commerce. So we're seeing this with new stablecoins like AUDD, the Reserve Bank of Australia's Project Acacia, the Wyoming State front stablecoin, the first state-issued stablecoin in the U.S., as well as growing the market share for existing assets like USDC on Hedera. In the month of August, USDC issuance grew and was up over 120%. The volumes over the summer were increasing over about 400%. So I expect to see more stable coins on Hedera and more market capture. For institutions, custody solutions have historically been the greatest technical barrier. And so as the regulation is really clearing the way for engagement, custody plays a key role and it really alleviates the fear around asset safety. Case in point, we recently saw one of Europe's largest custodians, DFNS, enable support for Hedera's ecosystem and its EVM layers. We've been really trying to address the access points and alleviate some of the technical uncertainty.
Yeah, for sure. 100% see the development there. And I think it's really important to hit both the retail and the institutional side with both of those types of products. So building on that and on a related note, some early DeFi participants argue that the industry with some of these solutions has drifted away from its original mission of financial accessibility and democratization. So from your perspective, how accurate is that view actually, and what steps could help realign DeFi with those original values?
Well, geographic barriers are definitely coming down, right? This technology is global, it's cross-border. Tokenization, I think, is also a lot about access to investment opportunities that people previously were walled off from. And then it's the related services like collateralized borrowing based on these assets that come with tokenization. So we're seeing increased access, increased purchasing power due to the borrow-lend nature, and ultimately new avenues of liquidity. Examples I would say really include tokenized commercial real estate from Red Swan, a US broker-dealer, tokenized money market funds via Archex for Fidelity International Funds, State Street Fund, BlackRock, and Aberdeen. But this is really a two-way street, right? We're also seeing Wall Street gaining access to crypto. And, for example, there are two NASDAQ filed HBAR ETFs, one from Canary and one from Grayscale, and then ETPs in Europe from 21 Shares and Valor. This is along with public companies putting HBAR on their balance sheet, ultimately enabling access without the need for complexities of digital asset custody. And that is applicable to both individual retail investors as well as institutions. So they're coming at it through a broad accessibility and through different access points.
Awesome. Yeah, thanks for that explanation. I think a lot of the most interesting things happening in crypto and obviously in the Hedera Foundation is this intersection between the two, where you can provide accessibility and permissionless access to some of these traditional tools. So let's switch gears a little bit and talk about fees. So one of the big challenges in DeFi is unpredictable gas fees, especially as it relates to network congestion. So how does Hedera's approach differ from other chains like Ethereum or Solana?
So I would say, unlike other networks, Hedera has low and predictable fees. They are paid in HBAR but denominated in dollars. And this provides fee transparency for individual investors. And it also enables CFOs of large corporations to budget based off of their projected usage of the network. And this is really quite a big differentiator. We feel that we are in this, as an industry, in a user adoption phase. And that surge pricing is friction, not a feature. And we're not talking about small percentages either in terms of surge pricing. Other networks have 1,000x increases or more. So it's quite substantial.
Definitely a unique differentiator for the Hedera ecosystem. So kind of diving in a little deeper on that point, can you walk us through how fees are actually determined on Hedera and why they can remain stable even when that demand spikes?
I think the fee model for most chains was designed like Uber or Lyft, due in large part to the inability to scale. So they created these perverse financial incentives to limit transactions. And you get transaction fees that end up being thousands of dollars for a cost that really should just be fractions of a cent. Hedera doesn't have this problem where there is limited block space or network congestion causing downtime. We've seen this, of course, over and over again in other networks. if you take a look at the last calendar year as an example, Hedera operated at peak transaction throughput that was over 100x the peak observed transaction throughput for Optimism. This one of the scaling solutions for Ethereum. So Hedera's governing council, these are the Fortune 500 firms that run the network. When establishing the fees, they took this into consideration, and it's certainly aided in terms of one of the differentiators of the model.
Definitely. Thanks for the insight there. And on a related note, so for users interacting with DeFi protocols like Bonzo Finance, how do deposit and withdrawal costs compare on Hedera versus, say, Aave on Ethereum or other EVM chains?
Right. So gas fees can fluctuate on Ethereum dramatically. So it's hard to make the exact comparison, but the fees are fixed in dollar terms on Hedera. But there's also an impact on market structure. So for margin lending, right, as is the case with Bonzo Finance, liquidations can occur if the loan-to-value or LTV ratios rise. With Hedera's low fees, micro liquidations can occur, even for very small positions that on other networks would be uneconomic for other chains to actually execute. So there's a benefit to the functioning of the market structure of the borrow lend. And then on the rate side, USDC borrowing APYs on Bonzo are about 10% today, I think, and it ranges from 5 to 8% on Aave, and so lenders are getting a more attractive return at the moment.
Awesome. Yeah, thanks for the color there. And I guess zooming out a bit from there, looking at institutions specifically, why is predictability in fees so critical for the larger scale adoptions from these institutions?
It really just enables large scale use cases. These large scale use cases require predictable fees. For example, the currency FX market trades around 4 to 5 trillion. That's trillion with a T a day in the UK alone. So two of the UK's largest financial firms, Lloyds Bank and Aberdeen, they're trading partners. They have enormous FX exposure to each other, and they're using tokenized Aberdeen money market funds on Hedera from Archax to really enable intraday settlement of margin, and this reduces the counterparty risks that they have. Or you can take invoice financing as another great example. Isle Finance, a fintech that is backed by the Taiwan National Development Fund, they provide factoring for Apple supply chain vendors, and they're going after a $2.5 trillion liquidity gap, and their business model is relatively simple. It's there's a shipping container of parts that are shipped across the world to an American company, and an invoice is sent. But the suppliers on the other end of that, they have to wait months or weeks to have that cash actually arrive. And so Isle Finance is providing delivery versus payment. And in doing so, they're creating new DeFi yield opportunities for investors, addressing just a genuine business need for an institution.
Yeah, definitely a lot of use cases that Hedera uniquely unlocks via this fee model as opposed to other networks. So thanks for the insight there. And then moving on to a related technical topic, let's investigate front running and MEV. So both of these are major concerns on Ethereum. How does Hedera's fair transaction ordering help to prevent these problems?
Hedera is a unique technical achievement. It's not a fork of Bitcoin. It's not a fork of Ethereum. And as such, it just simply doesn't have the concept of maximum extractable value, or MEV. This is immensely important for the trading of securities, where front running is illegal activity in most markets. And frankly, it's a terrible retail user experience too. Who wants to be in a position where the price of their purchase goes up because someone saw their trade order and stepped in front of them? And that's a terrible experience. So Hedera is unique in that it has a sequential ordering of transactions without this risk.
Awesome. Yeah, definitely a stark difference there between other networks. And so can you explain how this ordering model impacts both regular traders and the protocols themselves on the Hedera network?
So this is really where tokenization on Hedera shines. It's really showing its utility. So when a stock or bond is tokenized, it becomes a building block. And we're seeing tokenized equities like Apple, Tesla, NVIDIA stock from one of our ecosystem partners, Swarm. And we're seeing tokenized fixed income from KAIO, such as funds from Laser Digital, backed by Nomura, which is one of the governing council members of Hedera, and large hedge funds like Brevin Howard, as well as in Dubai, by Zamlink, which is also doing tokenization. So, for traders, now these assets can serve as collateral for lending. They can be integrated into DAO treasuries, and they are more accessible to people globally. And for institutions, like we've seen with Lloyd's Bank, it creates asset mobility. It creates the ability to manage risk in a more fluid way. You can remain invested rather than having to sell assets, reverting back to cash to make margin settlement. Ultimately, what it's doing, it's transitioning a static investment into a more dynamic, interoperable tool, that building block.
Awesome. Definitely a more overall fair ecosystem for all participants within the network. So moving on to another technical aspect of Hedera that is emphasized often is the instant finality. So why is instant settlement speed so important in DeFi?
So it's the difference between waiting seconds, minutes, or hours versus getting instant settlement. That can mean the difference between capturing an arbitrage opportunity or missing out on it entirely. And for institutions, real-time settlement, it reduces risk, it reduces counterparty exposure, it reduces the capital that's tied up in pending transactions. It really enables more of these sort of complex trading strategies like arbitrage or automated rebalancing that require sort of this instant execution. And for individual investors, it too has benefits in terms of that instant finality means you can immediately use your assets after a trade without having to wait for confirmation. So you can redeploy it.
Awesome. So building on that, you hit on this a little bit, but can you share some examples where this faster settlement changes the experience for maybe specifically users, whether retail investors, institutions, or developers?
So the faster settlement usually is most impactful on the receiving side of a transaction. For example, let's take a margin call. When a margin call has been met for a borrower-lend relationship, that finality is really important. And or you can take a exchange as an example. When you send assets to an exchange, they're actually fronting you the purchasing power for some period of time, or they are delaying the ability for you to trade until there's a certain number of block transactions or block confirmations that have occurred. This is to prevent just the double spending. So they're waiting for a low probability of double spend. They call this probabilistic finality. With Hedera, you have sub 3 second legal finality, deterministic finality. And so once it's confirmed, there is zero probability of a double spend. This really reduces the counterparty risk. It enables higher confidence in next steps, like making that next trade or lending out an asset.
Definitely system performance more akin to what you would find in traditional finance as opposed to other blockchain-based experiences. So thanks for the insight there. And let's talk about some ecosystem projects on Hedera. So what type of projects are being built on Hedera today that best demonstrate its focus on accessibility and inclusivity?
So let's take Swarm as a great example. They recently tokenized public equities, enabling this on Hedera, that are compliant. They are DeFi enabled, and they're insolvency protected. This last part really means that were Swarm to go away, the holders of the assets would not be tied up in bankruptcy court. I think the industry became all too sensitive or accustomed to this with the collapse of FTX, BlockFi, Voyager, et cetera. So, this is a real big differentiator. In addition, the DeFi enabled aspect, this is and giving an access point to the U.S. financial markets, to public equities in this case, that may not have been accessible to people in different geographic or locations.
Yeah, it's awesome to see that Hedera is promoting these original aspects of the crypto ethos and that we're still pushing that part of the industry forward. So that's great to see. And maybe looking ahead to the future, are there any upcoming fee schedule changes or governance proposals that users could be aware of? And how do you balance keeping fees low while ensuring network sustainability over time?
So the Hedera network will be raising the fee for a particular transaction type, a consensus submit message transaction, which previously was 0.0001 cent, and it's being changed to 0.0008. This will occur in January of 2026. So it's an 8x increase, but still we're talking about a small fraction of a cent. And this is in fact the first transaction fee increase for Hedera since 2019. And it's really intended to better match the actual cost of the network resources. This was instituted by the voting governing council members, these Fortune 500 firms that I previously mentioned that guide the network and ultimately the fee model.
Awesome. Thanks for the insight there. And I guess beyond fees, what features of Hedera's stack are you most excited about for the coming years?
Yeah, so Hedera is post-quantum ready, and I think that will become increasingly important aspect for security protocols, all protocols themselves. If quantum computers can break the security encryption of protocols, then assets are not safe, immutability isn't intact, double spends can occur, along with just a whole host of other problems. So I think being prepared for the advancement of computing and compute is prudent, and Hedera has been well ahead of the pack there. Continues to be solving problems that other networks will have to face in the future.
Yeah, definitely a persistent topic of conversation within crypto circles about when the reckoning day will come for that. So it's great to hear Hedera is ahead of the curve on that front. And I guess zooming out again, looking at the broader crypto ecosystem, how do you see Hedera's model influencing the evolution of DeFi across chains throughout crypto?
So we've joined various tokenization standards and are in support of ERC 3643, ERC 1400, and other standardization contracts for securities. As a EVM compatible chain, we feel that this innovation that can really occur anywhere on any EVM chain can be brought to Hedera when it's ready to scale. And so there really is no better home than Hedera for deploying, and it's just getting easier and easier.
Awesome. That's great to hear. And that's all the questions we had on our end, but I'd like to give you a chance to voice anything that we didn't ask you about, anything else you're excited about in the Hedera ecosystem or otherwise.
So, within the Hedera Foundation, we have 3 core verticals. I of course, am focused on the financial markets, but our ecosystem, as well as our enterprise and supply chain focus is growing in equal parts. One of the areas that I find to be most exciting and has applications across all sectors of the economy is AI. And so there's been a tremendous amount of development work within Hedera on the AI front, both from projects like Prove AI, which was Casper Labs, as well as EQTY Lab, and integrations with ELIZA OS and other AI frameworks. And so both the ability for AI to start to execute for us, and I think today the experience that many people have is sort of a talk to me phase. You can talk to an LLM. We're moving more towards generate yield for me, execute this, buy this for me, and that plumbing is being built on Hedera, and the developer ecosystem and developer participation has been immense. Some of the largest live coding sessions we've had have been integrating with ELIZA OS. And similarly, addressing a trust problem. All right. The blockchain industry as a whole is so incredibly situated to address trust problems. And the reality is we can't really trust AI. We know there's hallucinations. We don't always know the provenance of where data is coming from, or where the compute is occurring. And so the ability to validate, have verifiable compute is something that will be incredibly important for us and for society as the reliance on AI continues to expand. And Hedera is at the most foundational level of this problem, working through these projects directly on the silicon level of chips from Intel and NVIDIA that are running these LLMs to be able to say, where did the compute occur based off of what, and have greater trust in AI. And that is, I think, going to be the source of the next trillion transactions that occur. It's not going to be person to person. It's going to be machine to machine. And that to me is really exciting. And I do think that's going to occur far faster than anybody really expects, just because of the pace of AI growth and adoption. And it's an exciting time.
Yeah, most definitely a lot of synergies between crypto providing the trust to AI systems, and exciting to see Hedera at the forefront of that, and that could potentially be the next great vertical within the Hedera ecosystem. So very excited to look forward to that as well. Gregg, it was a pleasure talking to you today. Do you want to let everyone know where they can find you on social media or elsewhere?
Absolutely. Yeah. The best ways to reach out are through hedera.com for the network and Hedera.foundation for the foundation. We're here to help builders and enterprises engage with the Hedera protocol. And you can find me online on X at Gregory Bell.
Awesome. Thanks, Gregg, for the time, and hope you have a great day.